What's going on, everybody? Today we have another video that I wish I had when I first started investing. We have about 3 or 4 of these videos now on the channel, kind of in this same style. I love making these, and I've been investing, if you're new to the channel, for about 3 years now. And in the grand scheme of things, in investing, kind of lifelong journey, not a super long time, but definitely long enough for me to have learned some lessons the hard way, had some revelations that I want to share with you in these videos. And that will hopefully accelerate your path to becoming an independent investor. So if you are new, hopefully I provide enough value to earn your, subscription to the channel. And you can hit that like button if you're not new here. Welcome back to the sporadic upload schedule. So today we're talking about based on fundamentals. What the heck does that mean? You've probably heard a lot of people say that, whether they're talking about their investments, trading around their positions. They say, oh, I'm going to make these moves based on fundamentals. I'm going to sell only if the fundamentals change, right? And what the heck does that mean? Because sometimes it feels so vague, almost like they don't even know what they're going to do. And they kind of just use this as the blanket statement. So I kind of recently thought of a way that would allow us, or at least allow me, to visualize what this means based on fundamentals. So I think this is going to be really, really beneficial for especially any new investors out there. Let's just get right into it. So starting off with a chart. This is going to be the basis for the whole video, so make sure you understand what this chart means. Just lock in here for like a minute right now. So starting with the dotted red line or maroon line on the bottom, that's earnings for the company. So we have to make a couple assumptions and kind of restrictions for this example to keep everything uniform and simple. So first assumption is that the companies we're analyzing, they're all profitable. Okay, this company is profitable, which is why we can say earnings and profit are interchangeable. Some companies don't produce income or earnings or profit yet. They just produce revenue. And so we're going to assume this company is generating earnings and sees consistent earnings growth, meaning they see 10% or 20% earnings growth every year. Okay, so that consistent growth will actually lead to kind of a curved line or a trajectory like this if you do out all the math. And we're going to say that this chart is over the time frame of 5 years. This is a 5-year chart. Okay, so that's the first assumption and the first line. Then this blue line here that we can kind of see going like this, that is going to be the market cap of this company. So publicly traded companies are, I guess all companies, you could argue, do have a market cap. And you can find that by taking all the shares outstanding, multiply it by the price per share. It's basically how much is this company worth. And a lot of times the way you can find an estimated value for a company is by using a ratio like the PE ratio, or price to earnings. And the way you find price to earnings is just the market cap divided by the annual earnings of a company. And that's how you find the PE ratio. And it's probably one of the most famous ratios in investing. And for the sake of this video, we're going to say it stays at 10 throughout these 5 years. It's locked in at 10. And that's very unlikely. Stock price moves every day, and sometimes the multiple for a company might change based on growth prospects or how management's doing or the margins and stuff like that. We'll get into all that in a second. But assume the PE stays at 10 for these 5 years. It's also a little unrealistic because not a lot of companies trade at a PE of 10 these days, more like 20 or 30 or 40. But that's the other assumption. And if it stays locked in at 10, it's also going to have kind of like this sloped trajectory. You might think it'd just be flat, but it's actually sloped. And then lastly, this black squiggly line that's going over the blue line, the market cap. I should actually write market cap in here, but that black line, that squiggly line, is the day-to-day stock price. So I'm just going to write market cap. So this is the day-to-day stock price, this black squiggly line that kind of goes like this. And we're going to use, that's going to change from example to example. So with all of that set up, hopefully you got everything. This is basically just supposed to show us the expected trajectory of a stock with consistent growth and the same earnings multiple for 5 years. And ideally, you'd want the stock chart to look like this over 5 years if it stays based on fundamentals. So I guess another thing you could say is the fundamentals here is the earnings. This is the fundamentals. How much is this company generating in income, in profit? And then the other part of the fundamentals is the PE multiple, right? Fundamentally, you're probably not going to see a lot of companies trading at a PE of over 200, right? And you're probably not going to see a lot of companies trading at a PE of like 0.5. So we take 10, and that's, a reasonable, fundamentally sound estimate. Now, This is an example of when the stock price is disconnected from fundamentals. This is our first example here, and this is where it gets really valuable in my opinion, and where you can spot deals and maybe where you can spot some sketchy stocks that you might not want to be in. So right here, this first example is a company being undervalued. So if we go back and we analyze the day-to-day stock price, which is a squiggly line, right? Well, right here, the PE is still 10, the market cap still meant to look like this, based on earnings. Based on their earnings, we are told that the market cap should still look like that blue line, but for some reason, the stock price went down, meaning the market cap is actually went like this, right? So it fell off from the path that it should be following if it is still based on fundamentals, which means that usually this company would be considered undervalued for this time period right here, because it's below the expected path for the market cap based on the earnings and earnings multiple. Okay, so why would this company be undervalued? There's a lot of different reasons for that. So to give you a few examples so you can actually go and apply this in your investing, some examples for a drop like this right here could be maybe a macro event. Maybe, I don't know, this is a company that relied heavily on debt and interest rates shot up out of nowhere. And so this company got hit really hard and harder than the broader market. Or maybe management really messed up and had a terrible acquisition that just ruined the company. Or perhaps product failure, right? A company that I've invested in is Maxar Technologies, and they had a massive drop. I think they dropped like maybe 90% plus because one of their satellites failed. They're a satellite technology company. One of the satellites failed. Management levered up the company like crazy and just did not do a great job trying to recover. And that caused a huge drop like this. And then maybe there's competition, right? Maybe competition came into the market and kicked them out, and they're no longer going to see this earnings growth. And then maybe it's market ignorance. Maybe the market, as it often does, lumped this company in with another group of companies that they assume it's similar to, and they sold off that whole little group there when really this company is actually a thriving business. So there's a lot of reasons why you could have a drop like this, and it could be undervalued temporarily. But you also want to avoid what are called value traps. So stocks that look really attractive, maybe they have like a PE that's really, really low, and it looks like a great value play, but maybe it's there for a reason, right? That would be like a value trap when you think a company should be trading at a higher multiple when really there's a reason why it's trading lower. So that's where due diligence really becomes important, and you cannot only look at the multiples and trade based on that. So because fundamentals includes a lot more than just the earnings and the multiples. It includes growth rates, management, total addressable market, and all that stuff. But for the sake of keeping the example relatively digestible, here we go. And then hopefully if you get it right and you have all this time to buy, right? This is like maybe a 1-year period here. You have all this time to buy where maybe it doesn't move a lot. That's great. Accumulate a bunch of shares. And if you're right, it will appreciate back to fair value. So I guess you could say this line, maybe a better name for it is fair value for the stock or expected value. And so it'll appreciate and you get a nice payday. Now, this is the other side of trading or investing based on fundamentals, where something is fundamentally overvalued. What does it mean if it's fundamentally overvalued? So based on, let's say this right here, the daily stock price has shot up over the past like couple of years and just got way ahead of itself, right? Earnings did not go up 200%, but the stock price did. And that's where it's fundamentally disconnected, because earnings did not reflect this kind of growth, right? So the fair value for the stock is still down here, but the daily stock price is up here. So over the long run, they say valuations matter, okay? So right here, why would this stock be overvalued? Maybe it's hype, maybe Jay Powell go burr, maybe it's the media just pumping the heck out of the stock, maybe it's a small float, maybe there aren't that many shares outstanding and it's easily moved by a few big players. So this stock can stay overvalued for a year, right? There could be people coming in right here being like, hey, this stock is overvalued. And then it doesn't drop for another year or 6 months or even 2 years. And people could be laughing at them the whole time. Then all of a sudden, over the long run, valuations matter. So you could see a big crash like this, and then it trades sideways till it catches up with fair value based on fundamentals and then continues upwards. Or maybe instead of crashing, it just trades sideways for a little bit, right? Until it catches fair value again. So this is often what you saw with maybe some stocks in the dot-com bubble. They kind of crashed and then traded sideways because they, even after crashing, they still had to catch up they still had to let their fundamentals catch up, right? So that's what I kind of talk about. Sometimes my stocks get a bit overvalued in the short term, but I'm like, this company is continuing to perform. They're continuing to beat estimates as well. Say my stock is like at this stage right here. Say my stock's right here. I mean, if it's this high, I'm probably going to trim some. Okay, so let's actually say that one of my stocks is trading like here, right? Yeah, I mean, I could sell and probably walk away and probably avoid like a little correction here. Or if I know the fundamentals are continuing to improve, maybe I just hold on, right? Because if I sell here, I'm kind of betting that I'll be able to get in at a better price and it will drop. But maybe instead of dropping, it just trades sideways and waits for the fundamentals to catch up. So hopefully that makes sense. And that's why sometimes it's worth holding through short-term overvaluations. But it's, this is not financial advice. You definitely want to form your own portfolio management strategy. Personally, after the past couple of months, I realized I'm definitely going to be trimming my more speculative positions if they become overvalued, and maybe not so much my core positions that I have the highest conviction in. But my lower conviction ones, I'll probably trade and rebalance over a few months at a time to make sure they don't get too out of control. Anyways, let's go into some real life examples. So, okay, of course, this blue line, and this red line, the earnings and everything, they're not going to match up with Apple, but they're really just here to give you an idea and recontextualize, like, hey, a company with consistent growth and, a regular multiple should be able to kind of look a bit like this over the long term. So this is actually a 5-year chart for Apple. If you look right here, 5 years, and this is 2016, 2021. And so it kind of trades like that, right? It has that little curve upwards. So I'd say Apple, pretty normal. There were probably a couple times where it got a little undervalued, like right here. I think Buffett got into Apple in late 2018, if I'm not, correct me if I'm wrong, but I think, Buffett did get into Apple at a point where he felt it was undervalued, and he felt that the business fundamentals, it was one of the best businesses he'd ever seen. So that's a great example right there. And then Tesla is an example of a stock that stayed undervalued for a really long time and then shot upwards, right? And now maybe it's a little overvalued. So if we redraw this, maybe it looks more like this. Maybe the fair value of the stock looks more like this. Or you know what? Maybe it looks more like this, okay? So I'm not saying Tesla is fair valued, overvalued, undervalued right in here. This is just literally a napkin math kind of scenario. But Tesla was increasing their fundamentals, improving their fundamentals for several years before it really got noticed, and it was also being shorted really heavily. So sometimes an artificial situation like GameStop, where it was just artificially suppressed by a bunch of short sellers over 100% short, right? Then boom, it appreciates to fair value, but maybe gets a little ahead of itself and then needs to come back down. Now, I mean, recently, Michael Burry thinks that Tesla could fall 90%. So maybe the chart looks more, the fundamentals look more like that, and it needs to keep falling further. But this is an example of undervaluation for a while, then realization of fair value, and then maybe getting ahead of itself a little bit. And then second to last example here in this video, we have Amazon, okay? So Amazon, again, recontextualizing with this blue line and this red line. Amazon is a company that has always improved its fundamentals. Amazon is absolute beast, and it's just continuing to expand into more and more markets because it can pretty much do whatever it wants at this point, let's be honest. And now recently we've seen Amazon kind of consolidate flat here for a while. And you're kind of wondering, right? A lot of people are starting to say, hey, Amazon's kind of undervalued. Amazon's kind of undervalued. Well, recently, people started saying that kind of right around here, in my opinion. People started saying that more and more often. And if you take what we just talked about for the past 14 minutes, right? It's because maybe, just maybe, the fundamentals are starting to surpass the market cap or the stock price, right? And so now it's become undervalued based on fundamentals. Now, another argument you can make is perhaps, maybe not with Amazon, but sometimes stocks can, their stock chart over a while can kind of go like this, right? It's like an S curve and it flattens out. And this flattening of the stock or market cap, or whatever you want to call it, could be because of maybe slower growth, or maybe multiple contraction. Maybe they don't deserve, like in the example, maybe it no longer deserves a PE of 10, it deserves like a PE of 7. So that would cause the fair value to go down. So, but with Amazon, I would argue that it should not see multiple contraction right now. The growth story is still intact. So I don't think that's the case for Amazon. I don't think that they should be starting to flatten right now or see the flattening of that S curve quite yet. So that's another thing to think about, and hopefully a good example in the real world. Or maybe, maybe growth slowed, or maybe worse margins. Maybe their margins are, this is for more general example, not specifically for Amazon, but maybe another reason they're starting to flatten out is maybe their core business is deteriorating. And then lastly, the last one I want to talk about is one that I recently took a position in, Alibaba. I have a video coming up for you guys soon on Baba and my kind of full thesis on that one. But look at this, okay? So again, blue and red line, not exact, not perfect, but Alibaba is back to where it was in 2018. It has wiped out 3 years of gains. I guess you could consider it, say maybe this doesn't count as gains, but it's wiped out at least a year of gains, right? This is like a solid year of gains, gone. And it's back to 2018 levels. So maybe this means that Alibaba was just really overvalued here. Maybe it was really overvalued and it took 3 years to catch up, for the fundamentals to catch up. Or maybe it means that the fundamentals have surpassed now and Alibaba is indeed undervalued. And if you go back and look at some of my other videos, I point out how Alibaba's ratios, today we've been using the PE ratio, Alibaba's PS, PE, and price of free cash flow, they're all pretty much near 5-year lows. So I don't think it's the case that Alibaba is, overvalued right now. I think it's just a case of a discount due to them being a Chinese company and the unknowns regarding kind of the CCP and stuff like that. But anyways, I hope this video was helpful for you. I hope it was able to help you visualize what it means to invest based on fundamentals. And if it did, make sure to hit that like button, subscribe, and also investor community. We are still having a 7-day free trial. It's previously my Patreon. It's a place where I make exclusive videos that aren't posted here, and we have live mentor sessions teaching stuff like this, even more in depth than you would see on my channel. And for example, this next weekend, we have an interview with the popular investor talking about macroeconomics, Bitcoin, Palantir, all that stuff. And then we have the week after that, building out actual financial projections, how to build out an income statement and make your own revenue projections and build your conviction looking into the future, right? Because if we're right here, you should be able to make these projections yourself. We're literally teaching people how to do that. Nick, full-time performance analyst, CFA level 2 candidate. And we also have another teacher, mentor, Kevin D, who's been a full-time trainer for several years, teaching people up on TA. So if you want, link down in the description below for that or in the pinned comment. I'm excited to see you there. Try it out for 7 days. If you don't like it, don't worry. No hard feelings. And if you do, hopefully you stick around. I'd love to have you there. Lastly, making to this point in the video, you are the real MVP. Don't forget your peace and thank yous. And here's a quote of the day. All right, bye.